Hello and welcome to our webinar here on 5 simple steps to smarter stock control. This is brought to you by HPP Systems and Cameron Computers. We've had many years of experience in the account software industry, and in particular some of the solutions that sit around that account software. And one of them that we've worked with for many years is stock control systems, whether it's in a warehouse or a stock room. We've got a great experience in working with businesses in streamlining their stock control and making sure they're maximizing the efficiencies available to their business. In terms of an introduction of myself, my name is George Smith. I'm the Managing Director at Cameron Computers, one of the companies within the HPP group. My own personal background is I started as an accountant working in audit. So I spent many years traveling around different businesses of various sizes, and seeing what they did well and what they did not so well. And stock control was one of the biggest areas that we'd spend time in, because there was always issues, there was always inefficiencies, and there was quite often accounting errors as well. So it was definitely a place that I've had a lot of experience and seen, like I said, some things done very well and some things done not so well. So in terms of what we're going to cover today, first of all, I'm going to start with a pretty important question that sort of justifies why we're here today. It's why effective stock control is so crucial. We're going to go into how we're going to improve it. We first of all need to ask ourselves, why is this important to our business? So I'm going to answer that first and give you the reason that I think this is a place which is worth you spending time thinking about in your business and investing resources in getting it right. And then I'm going to keep it down to 5 simple steps, and I've used ones here that I believe, regardless of your industry or the nature of your stock, these could all be applied to you. So I've tried to keep these as useful as possible for any type of business. Some will naturally be more important than others, but I think they're all worth considering regardless of your business or your size of business. And they're all something that's obtainable for everyone, I believe. So that first question then, why effective stock control is so crucial? There's a few sides to this, but essentially the message I'm giving you here is that I believe effective stock control will save you money. It will make you a more profitable and efficient business. The first risk you've got with ineffective stock control is wastage. Some businesses waste huge amounts of cash and working capital on wasted stock. So when you've wasted stock, what does that mean? Well, it means you've bought too much, or you haven't sold enough. Essentially, you've misjudged the supply and demand of your product, or you may not have had the visibility of your stock to be able to meet demand at the right time. So one thing that we see very often is that people have a poor picking policy. That means that they're not always picking the oldest stock first. So it's not that your stock's not coming off the shelves. It's not that you're not selling it. It's just that you haven't got it in the right places to meet demand and to use it the most efficient way possible. Companies like Tesco's, every £1.07 that they spend is thrown away in terms of stock. Obviously, the nature of your business will indicate whether this is going to be a significant issue or not. If you're in a business that's selling perishable goods, then this is going to be a huge priority for you and a huge concern for you. But even if you're not just selling food and things that go out of date very quickly, it still needs to be down for consideration, because plenty of different product lines go out of fashion or become out of support, whatever it may be. Even if it's not within the week, you need to keep an eye on this, because you don't want to be wasting stock that a year ago or 6 months ago or a month ago could have been sold. So stock wastage is one of the biggest issues we have through poor stock control. The flip side of that is stockouts or sellouts. What's one of the most painful experiences for any retailer or anybody selling products, when you've got demand, you've got a customer who wants your product, but due to a miscalculation, either we didn't order enough in, or it's in the wrong store, or whatever it might be, we haven't been able to meet that demand. And like I said, there's nothing more painful than a customer ready to buy, but you don't have the stock for them. So this is a real concern for, again, retailers or any supplier of a product line. Again, a bit of a statistic that really shows the impact of this and how it's a real product issue is, in the US, they estimate that the average business would grow its revenue by 7% if it didn't have any stock outs or sellouts. So basically, we're missing out on around 7% of sales every year because we didn't have it at the time and in the place that our customer wanted it. And only through really effective stock control can we get close to finding the balance. Because essentially, that's what this is. It's a balance between the wastage risk and the sellout risk. We want to have the optimum amounts of stock. One solution would be, well, let's buy more than we think we need. Then you're going to have the wastage. Or if you try and be efficient and keep your stock levels at an efficient level, you run the risk of a sellout. So only with effective stock control, when you've got complete visibility and control and confidence in your stock numbers and your order process, etc., can you find the balance between these two. The third item here, why I believe stock control is just so vital to a business, essentially boils down to the simple fact of cash flow. For many retailers, many businesses, even in manufacturing, distribution, stock can quite easily be the biggest investment you have on your balance sheet in terms of a current asset. You've got to buy stock to grow your business, to sell your business, but for many businesses, it's its biggest risk as well, because all of that cash is tied up in stock where it could be working in more efficient ways in your business. And it's, again, all about finding that balance. We want to have enough stock not to disappoint our customers. We don't want too much to waste. And what we don't want is it sitting on the shelves for longer than we can handle in terms of turning around cash, because our suppliers don't care if we haven't been able to sell it this month. They want their payment terms and they want their cash. So if we're going to manage cash flow properly, we need to find that balance and have stock moving efficiently through the business. And the only way to do that is with effective stock control. A nice takeaway here, useful calculation that I use with lots of clients and customers to judge where they are with their stock right now, is this stock days calculation. And basically what this is calculating is, on average, and it is average, it's high level, how long is an item of stock sitting on our shelves? To do this, if you do want to do this on an annual basis, you take your year-end stock evaluation, the cost of purchases of that stock through the year, and times it by 365. And that will give you a day's number. It will give you how long that stock on average is sitting on your shelf. If you want to do it more often, great. Do this monthly stock valuation divided by cost of purchases within that month and times it by 30 or 31 days. That will give you the same answer, but on a month by month basis. And you might be thinking, well, I need a benchmark here. What's a good target to aim for? Well, it's really going to depend on your industry here. We go back to that example of Tesco's. They're going to want a nice low stock days when they're selling apples and fresh veg and fresh meat. That can't be longer than a week, a couple of days. Whereas if you're in the high-end car business and you're selling luxury cars, you'd love to be shifting them every 3 or 4 days, but it's going to be longer than that. So you've got to filter those expectations. Some tips to take away. If you can't, look at some competitors, even if there are bigger players in your market who've got their accounts available publicly, or you can do this calculation on them. Benchmark yourself against some of your competitors and make sure you're beating them within your industry. Or another one that I like to take away with, regardless of industry, is think about your supplier payment terms. So on average, what are your supplier payment terms that you're paying for this stock and these products? Are they 30 days or 60 days? Well, a lovely target to aim for will be to be turning over your stock to be sitting on the shelf for less time than it takes for you to pay your suppliers. So if you can get that under 30 days, then at least you're turning around your stock, you're getting the cash back before you even have to pay back your customer, your supplier. So you're really maximizing your cash flow there. Right, it's now time to get into some of these practical ideas I have and these steps that I have to improve stock control, will ultimately address these concerns that I've covered already that are common with people who have to manage stock in their business. The first one's what I've called mix up your stock counts. Now, hopefully everyone's doing some form of stock count at some time in the year. Most businesses we come into and work with, they're doing the standard annual stock count. They're counting everything once a year. So once a year, they're getting complete verification and comfort over their stock. They're writing off differences and losses in their accounts when they've found any, and then each year they've got a fresh start. Now, I absolutely believe that that is the right thing to do, that you should be doing that stock count, and perhaps you should be doing it even more than annually. But what I'm suggesting here is we don't ditch that, but we build on top of that, and we do something called perpetual stock counts. So a perpetual stock count is essentially what I call more of a control rather than a full verification. What you're doing is you're counting a specific amount of stock, partial count, gradually throughout the month or the year. So it's a far more manageable. We're counting a smaller amount of stock, but what we're doing is we're flagging up issues rather than getting complete verification. So how do we go about that? Well, first of all, you need to find a characteristic that's going to be your counting criteria. So are we going to do this by location, by product category, by a random selection even? But you need a way that you can systematically then work through the business, through the stock available in the business. So over a set period of time, in theory, everything's had a chance of being counted. So what you do, let's pick location. You're going to do it on aisles. So here's an example here. We've got a warehouse with 26 aisles, A to Z. Each day, we're just going to count one aisle. So it won't take too long, and we'll just count that one aisle. And then throughout the month, for 26 days, we've counted every aisle, and we'll start again. The important message here is I'm not telling you that this will guarantee all your stock is right all the time. It won't, because you're not counting it all. What it's doing is it's flagging up any potential control issues. So rather than getting to the end of the year and finding out we're having to write off thousands or tens of thousands of pounds worth of stock because of issues that we didn't even know existed till the end of the year, we're identifying them issues early. So if in aisle B we find an issue, we dig into it, we understand why it happened, and then we can address it then when it's a much smaller error. And when we get to year end, hopefully, when we do our full verification, there are the same issues. So the benefits of this: limited disruption. We all know how painful it is to do a full factory or warehouse close down and to count everything. It's heavy on resources to do it in any manageable amount of time. With a perpetual stock count, this can almost happen live, because if you do it in small enough sections, you almost don't even need to close any of your warehouse or your stock room. You just quickly count the bit for the day or the week and then move on. Easier to handle resource, because one person can probably do this. And then what I've already mentioned here is it's about identifying, rectifying issues earlier. It's about, if we do, God forbid, have theft in the stock room, or if we have a control issue with stock sales order picking, we'll identify it early, we'll correct it. And then that means when we get to do our full verifications, we don't have these big inaccuracies when it's too late to fix them. So that's the first key step that I'd suggest, is that you essentially mix up your stock counts. Don't lose the full verifications altogether. Absolutely keep them in place. The more often you can do them, the better, depending on the value of your stock, the risk involved. But introduce these perpetual stock counts. And if you've got a system that enables you to identify specific areas of the stock to work through, whether it's an aisle or a product category that you can systematically work through, then it makes this a lot easier to do. Just a little reminder: the complete stock count shouldn't be removed. They're always got to be part of the annual process. So step 2, keep the counters in the dark. So we've introduced perpetual stock counts. We've introduced, or we're maintaining our annual complete verifications. Now, the way we go about that's important. So we're assigning to our counters different stock items to pick. So we have an expectation based on our accounts package on how much we expect to be in stock. What I'm saying about this keep the counts in the dark is we don't let the counters know what we're expecting. So essentially what we're doing is we're giving them the product items that we want them to count and the locations, but we're not telling them how much we're expecting, because you can imagine what's very common in a warehouse or stockroom environment. They've been given to count the products on the very top shelf. It's right up there. And we look at the list and it says we're expecting 20. A quick glance, yes, it looks about 20, that will do. And it's a tick, and that's all it takes. And it's not always about being lazy. or trying to deceive you. It's simply human nature. We have what we call confirmation bias, that we've got a lot of things to count, and we basically scan through. We see the number we're expecting 10 of that product. We have a quick look in the box, it looks about 10, ticket. Whereas if they don't have that expectation, they just know they need to count this box, they've got no choice but to count everyone there. It will take longer. It will be a longer process. However, it's giving you more peace of mind that you've got absolute accuracy. I really encourage even a mixture of these. If you can't do them all the time, do what we call blind counts, where customers don't get all of the counters don't get all of the information they need. Here's a little example of using our software, how a stock count might look. Here you can see it's not giving you it's giving you all the information you need to find the product to count, but it's not telling you how many we're expecting in our system in the accounts package. It's just giving you what you need to count it. Okay, so step 3. So we've been counting regularly. We're doing perpetual counts. We're doing annual full verifications. We're mixing up between blind and seeing counts. We've pretty much got counting down to a T now. Step 3, what I call match, match, match. This is all about the process, the purchase process, really, because if we get things right at the start, we've got a much bigger chance, a better chance of having a clean stock process throughout the business. So this is really all about that procurement process. And as a past accountant, I can tell you, if you put this control and this process in place, your auditors are going to love you, your accountants are going to love you. You're going to be demonstrating a clear set of financial controls that's going to help guarantee you an effective stock control system. So match, match, match. What are we matching? We're essentially matching the 3 key documents in any purchase or procurement process, and these are the purchase order, so what we want to buy, the goods received note, what we've received in from our supplier, and then the purchase invoice, what they want us to pay for. So these are the 3 key documents that drive any purchase process. And what I'm asking for is that we match these 3 against each other to ensure that they're consistent, and we're doing that in as real time as possible. So the first document there is the purchase order, which represents the trigger for bringing stock into the business, really. It's probably, hopefully, been signed off by management as a proof that, yes, we can go and buy this, so we know it's what the business wants. And it's telling us who in the business wants it, where it's going to come from, the specifics of the product we actually want to buy, the quantity of that product we want to buy, and the cost we expect to ultimately pay. So that's really driving all the details that's then going to flow through the business to end up with us having some stock and paying for some stock. So when we've sent out that purchase order to the supplier, and then this stock comes into our business, it comes into the warehouse or the stock room. Now, at this stage, what we're going to get is a goods receipt note. So a delivery person is going to provide us with, this is what you've got, basically. And that will reference our purchase order, but it won't necessarily be the purchase order or have the purchase order with it. So the first 2 documents we need to be matching is that purchase order, what we wanted, and the delivery note of what we've got. And it's absolutely essential here to match these at the time of receipt. What normally happens is purchase orders are sitting up in the finance room, or even in different departments, depending on who's raised them. And these goods receipt notes are coming into the stock room or the warehouse, 2 very different parts of the business. Now, what happens is the delivery note eventually makes its way upstairs to the finance room, and eventually these 2 documents are compared and checked. By then, it's too late. The goods have been received. We have to mess around with credits, or if there's differences, it can effectively be too late. So ideally, what we want is at the time of receipt, we've got visibility of the purchase order, and we match the 2 together. Now, invariably, there will be differences, and what we need to do is we need to have policies in place and processes in place to accept those differences or reject them. So we need to ask ourselves these sort of questions. Do we allow over deliveries? We ordered 5 on the PO, 10 are on the delivery note. Do we accept that? Does that need management approval there and then before we'll accept them? Do we accept under deliveries? And do we have a policy of what happens if we do get an under delivery? We ordered 10, we've received 5. Do we keep that purchase order open in the system that allows another 5 to be received at a later date? Or do we know with this supplier, they just send what they want and we'll just accept what we need, and the PO is closed straight away? What happens when a delivery comes in and there's no PO in sight? Something's been ordered without a purchase order, or the supplier sends us it. Do we have something that'll flag this up? Okay, we're going to accept them in because we know we need them for our customers, but what's flagging that up for investigation so it can be properly reported in the account, properly reported by management? We need to flag that up as an anomaly, basically, at the time of receipt. And then going back to what I was saying about the timing of this, this really needs to be live. This can't be a process where 5 days later that goods received note reaches the accounts department with the purchase order. By then, mistakes have been made. That stock could have flown all the way through the business and be sold by now. So we need to be in a place where the two have access to each other, that at the time of receipt, we've got visibility of the PO. We need a system that can deliver that for us. Okay, so let's imagine the stock's come in and we've matched it up. What we expected to receive, what we ordered, is what's actually come into the business. Brilliant, the quantities are correct, the descriptions are right, the products are right. Obviously, the final stage is we'll then receive an invoice from our supplier. And again, this is probably going to flow into the finance department, whereas that goods receipt note was down in the stock room or the warehouse. So we need visibility again. By now, we should have a matching PO and a delivery note that's waiting for this invoice to come in. And this is essentially triggering what's going to be paid in the business. So we need to make sure this is right. So what we paid for is what we received, and what we received is what we ordered. That's what we're aiming for here. And if we can get that right, it gives us a much better chance of having effective stock control, because we're getting visibility straight away of what's coming into the business. We're flagging up if we've got any shortfalls or any over deliveries, and ultimately we're only paying for what we've actually received. There's a bit of a summary there. We've got these 3 key documents: the PO, the delivery note, and the sale and the purchase invoice. We can match all 3 of these together. We've got a far better chance of having effective stock control. And the key is, all 3 of these documents could be in different parts of the business. The purchase order might be raised by department heads, so it could be people with non-financial, nothing to do with stock, raising these POs throughout the business. That delivery note will be flowing into wherever stock is accepted and kept, and the invoice is going to be definitely in the accounts department. So we've got 3 different documents in potentially 3 different areas. We need a way in a system that will give us visibility of all 3, regardless of which part of the process we're in, because we need to be matching them and flagging up differences straight away. Step 4, barcoding, and this is a really common change that we make in businesses when we come in. That normally, when implementing one of our systems or going through a review, barcoding becomes part of this. And the reason is barcoding delivers you efficiency. Barcoding makes all of these controls and all these different ideas we might have, it makes them easier to do, it makes them faster to do. So what are the benefits of barcoding? Well, first of all, reduce the risk of human error. We're not having to key in product codes. We're not having to key in quantities or whatever it may be. We're scanning, we're reading all that information off the barcode, and it's entering directly into our system. So immediately we're removing that risk of human error. We're also speeding up the process. If you've got 8-digit product codes and you're typing them in with every goods receipt or every sales order pick or every stock take, it's going to take time. Not only is it risk in terms of error, it's time consuming. We're speeding up that process through automation, basically. And it also means we can be a lot more ambitious in the data that we collect, because a barcode can hold far more than just a product code or a price. We can include in there details of the specification, we can include expiry dates, we can include batch and serial numbers. All of that sort of information can be held in barcodes. That means we can start reading and gathering a lot more data. So as our stock control procedures and processes advance, barcoding allows us to do that, and it doesn't hold us back from a human involvement. So barcoding is a really effective way of improving the efficiencies in your stock control process. And going back to, well, what is barcoding? It's simply a method of identification. It could be anything from a product to a specific attribute to a location. So many of our clients, they don't only barcode their products, they barcode their aisles and their bins. That means that when we're moving products from one bin to the other, it's a case of scan product, scan bin, and then scan the new bin that it's going into. Again, we're removing that risk of human error. We're speeding things up, and it's not just in the products themselves. Barcodes can be really useful throughout a warehouse or stock room. It does create some investment requirements and resource requirements in the early stage of setting up barcoding and having a process in place to barcode your products when they come into the business. But if you have the right system, all of that can be automated. So a new product comes in, it attaches a new barcode to it. We print that off, we stick it on the product, and it's barcoded and ready to go. As long as you streamline that and get that right, barcoding can be a really efficient addition to your stock control process. Now, the final step that we believe at Cameron HBP really important is integrating the finance of the warehouse. I've already picked up on this when I was talking through the three-way match, that there's important information that sits around stock that affects different parts of the business, that flows through different parts of the business. The two most important areas that you can integrate is your finance and your warehouse, because ultimately everything that goes into your warehouse, everything that flows through that stock room, from coming in, stock take adjustments to sales order picking and sending things out the door, it ultimately needs to hit that accounts package, it needs to hit that finance system. So if we can have a tight integration, we can have some huge efficiencies here, and we can gain real visibility of what's going on in the stock room. So to explain why I feel this is probably the most fundamental step here and one of the most important factors in an effective stock control system, I'm going to go back to a quite conceptual question here. Why does a business fail or succeed? In my opinion, there's three core areas that determine success in a business. And it's as simple as this: sales, costs, and cash flow. So if sales aren't what we expected, or if sales are ahead of what we expected, we underperform, we overperform. If we can't control our costs and our overheads, we underperform. If we can keep on control of them as our sales go up, we increase profitability and we over succeed. Ultimately, a combination of the two, and what really determines success or a failure of a business is cash flow, and with stock control, this is absolutely fundamental. So I believe these are three core bits of a business that determine its success or failure. So it's obvious that data that's associated with these three components needs to be recorded, needs to be visible to the management team, and needs to be as accurate as possible and as quickly accessible as possible. So what do we mean in terms of data when we come to these three components? From a sales point of view, it's obviously sales data, it's customer data. From a cost point of view, it's purchase data and it's stock data. From cash flow, it's got to be customer and stock. So what I'm talking about here in terms of customer data, I'm talking about debtors and what our customers owe us. From stock data, I'm talking about how much cash we've got tied up in that stock. Obviously, from a purchase point of view, we're buying it in. It's basically that purchase order process that I discussed earlier on, step 3. So as you can see, we've got these three fundamental parts to a business that our management, our directors need to have visibility of. And in two of the areas, stock data is prominent and vital. So it becomes so obvious that what's going on in our warehouse, what's going on in our stock room, has to be visible to the finance system, so we can have accurate reporting, so we can make decisions and not find out till the end of the quarter or the end of the year what's going on. We need to know this as soon as possible. But why doesn't this happen? Why doesn't information flow into the finance system as quickly and as efficiently as possible? The first one is time consuming. It takes a long time to every goods receipt note that comes in. Right, we need to check that stock into the accounts package so our stock levels are correct, so we can cost this properly. Well, that takes time to manually enter a goods receipt note into a stock system. All right, we've done a stock take and we found a difference. We're going to have to write off £5,000 of stock. Well, that requires a journal. It takes time, and if we're doing that time after time after again, It's going to take a lot of time. So it either puts people off flowing that information through to the finance package, or it just takes a long time, meaning it's outdated, that we don't get to find out about that good receipt till the week after. We don't finally do our stock take journals until a month after year end, when it's all too late anyway. Again, when you've got humans involved, there's a risk of error. If we're just manually entering our goods receipt notes, our sales order picks, our dispatch notes, everything like that, there's a risk of error. On average, it's around 1%. What you might think doesn't sound too bad, but ask yourself this: are you comfortable with 1 in 100 of your sales dispatches being incorrect? Are you comfortable with 1 in 100 of your stock take variances being incorrect? That's the sort of risk of error you're facing when you've got a manual flow of data between what's happening in your warehouse and what's happening in your finance system. And then really one of the biggest practical challenges is that information just simply isn't available for the transfer data to happen. So going back to that purchase order process, the goods receipt, we'd love to match that with the purchase order, but that purchase order's up in the finance department. And at this time, I've got a person here with a lorry and he's late on his next delivery, and I need to check these goods in. I can't just ask if he's got 20 minutes while I go upstairs and check the purchase order against the delivery note. So inaccessibility of information across the business is a really common barrier to why data doesn't flow. So that's why I was going back to having a system where it all integrates, where the person down in the warehouse receiving the goods can just see that purchase order, the bit of information they need immediately, makes a massive difference here. So hopefully in a short amount of time, that's given you a bit of an introduction to what I think can really make a difference in terms of effective stock control. Hopefully there's something there you can take away. It's quite practical. It applies to most businesses, regardless of size and industry. But to summarize, what have we done here? We've answered the question why effective stock control is so crucial. It's because it's a massive risk to inefficiency and financial losses in your business, whether that's through wastage, whether that's through selling out and stock outs, and ultimately whether it's having an impact on your cash flow if you cannot optimize your cash flow because of poor stock control. I mean, I've been in a business not too long ago that turned over £30 million. They did an annual stock and had no stock control. So they knew when things came in, but then once it was into their network of stores, they didn't really know again. That stock was never traced. All they did is at the end of the year, they did a complete verification. So once a year, they knew what their stock levels were. When we looked at their most recent financial accounts, with a turnover of 30 million, they had stock of £15 million. Because they had no visibility, because they had no control, they were essentially massively overstocking because they had a fear of a stock out. So basically, every 50p in a pound of revenue was tied up in stock. Really, really shocking results, really, but it's not uncommon. And just think what they could do in terms of their cash flow and profitability if they just, reduce that stock level by 10% or 20% through an effective system. It would make huge differences for them. And then we went into the 5 practical steps. So we had mix up your stock count, keep your complete verifications. Absolutely, they're really important to the business that you've got that complete verification on a monthly, quarterly, or annual basis, whatever you may do. But don't forget about perpetual stock counts as well. These are your control. These are your indicators of any concerns. These have been done regularly and frequently on small and frequent amounts. Step 2, keep your counts in the dark. Remove that risk of confirmation bias. Don't tell them how many you're expecting. It forces them to count exactly what's there and feed back to you. It might take longer, but it's going to be worth it. Step 3, match, match, match. This is the accountant's dream. Get that purchase order process right, that procurement process right, and then you're on a good footing for the rest of your stock control process. If it's coming in the right amount, it's what we wanted, it's what we expected, and ultimately we pay for what we got, we've got a much better chance of having an effective stock control system. And the key there was that match, match, match needs to be happening as quickly and as in real time as possible. Then we went on to barcoding, a real chance to improve efficiency and become more ambitious with your stock control. because you're automating data capture, you can hold more data, you can gather more data, and you're going to be quicker. So implement barcoding as soon as you can. And then finally, the step that I feel could have the biggest impact on your business, and this is a really strong message we try to put out to all of our customers: integrate your systems. And in this case, two most important: the warehouse or the stockroom and the finance system. Ultimately, that finance system is delivering the reporting that's going to allow your business to thrive or not. So you need to get all of the information, all the activity that's happening in your warehouse into the finance system as soon as possible. We didn't even get into there, if you have multiple channels of sales, how important it is that your finance system knows the stock quantity as soon as possible. How many sales are you missing out on because it's taking a week to get goods received into the finance system that are then available for sale? Ask yourself questions like that. So integrating your warehouse to your finance will make a huge difference and give you the visibility and control. That'll mean you'll be far more confident with your stocking levels, that ultimately allows you to find that balance between not wasting and not running out of stock. So thank you very much. I hope that was useful. If you do have any questions from this, please do get in touch with us either via our website or give us a call, and we'd be happy to put you in touch with one of our consultants who specialize in working with businesses on streamlining their stock control procedures. And obviously we can recommend solutions and technology that will allow this to become a reality for you. So please do get in touch. I hope that was useful. Thank you very much.